The average American pays over $500,000 in completely unnecessary taxes over their lifetime. $500,000, gone. Not because the tax code is unfair. Not because the system is rigged. But because nobody told them these 5 strategies exist. Here's the uncomfortable truth: most retirement planners get paid through commissions on the products they sell you: mutual funds, annuities, whole life insurance. They don't get paid to teach you tax strategy. So they don't. And the IRS? They're definitely not sending you a reminder about money you could be keeping. That job falls on you. But the good news is, the strategies we're about to cover aren't complicated. They're not reserved for the ultra-wealthy. They are sitting inside the US tax code right now, available to anyone who knows where to look. Stick with this entire video, because strategy number 5 alone could save you over $80,000 in taxes before you retire. Let's get into it. Most people think a Roth IRA is just a retirement account you contribute to every year. But the Roth conversion ladder turns it into a tax time machine. Here's how it works. A traditional 401k or IRA is funded with pre-tax dollars, meaning you'll owe income tax when you withdraw in retirement. But if you convert chunks of that money into a Roth IRA during low-income years, like early retirement, a sabbatical, or a career transition, you pay taxes now at a lower rate and never again. Here's a real example. Say you retire at 55 with $800,000 in a traditional IRA. If you convert $40,000 per year into a Roth over 5 years while living off savings, you might pay only 12% tax on each conversion. Compare that to being forced to take required minimum distributions at 73 in a higher bracket. The difference can be over $60,000 in savings. The latter part means you start conversions 5 years before you need the money, because Roth conversions have a 5-year seasoning rule before penalty-free withdrawal. Plan ahead, and this strategy is a legal masterpiece. If you have a high-deductible health plan and you are not maxing out your health savings account, you are leaving one of the only triple tax-advantaged accounts in the entire U.S. tax code completely untouched. Here is what triple tax advantage actually means. First, contributions go in pre-tax. In 2024, that's up to $4,150 for individuals and $8,300 for families. Second, the money grows tax-free inside the account. Third, withdrawals for qualified medical expenses are completely tax-free. But here is the strategy most people miss: you don't have to spend the HSA money on medical expenses right now. You can invest it. Most HSA providers let you put funds into index funds, and let it compound for decades. Then, after age 65, you can withdraw it for any reason at all and just pay ordinary income tax, exactly like a traditional IRA. That means the HSA is secretly a stealth IRA with an extra layer of tax benefit if you use it for healthcare. A 30-year-old who maxes out their HSA every year and invests it could have over $500,000 by retirement. Tax-free. The stock market drops and most people panic. Smart investors pull out a completely legal tax strategy called tax loss harvesting, and actually come out ahead on paper. Here is the concept. When an investment in a taxable brokerage account loses value, you can sell it, lock in that loss on paper, and immediately buy a similar but not identical investment. The IRS lets you use those losses to offset capital gains dollar for dollar. And if your losses exceed your gains, you can deduct up to $3,000 from your ordinary income per year. Any unused losses carry forward to future years indefinitely. Real example, in 2022, when the S&P 500 dropped 19%, investors using tax loss harvesting were able to offset thousands of dollars in gains from previous years. Someone with $200,000 in taxable investments could realistically harvest $10,000 to $20,000 in losses in a volatile year. At a 22% tax bracket, that is $2,200 to $4,400 back in your pocket, while staying fully invested in the market. Robo-advisors like Betterment and Wealthfront do this automatically. Or you can do it manually with a little attention in December. Okay, pause for 1 second. If you have made it this far, you already know more about tax strategy than 90% of Americans. But the next 2 strategies, the Backdoor Roth IRA and the 0% capital gains bracket, are the ones that high-income earners and early retirees use most aggressively. And strategy 5 is the one that literally no one talks about in plain English. Here is a quick recap of what you have learned so far. the Roth conversion ladder can save you $60,000 or more in unnecessary taxes during retirement. The HSA Triple Tax Advantage can build a $500,000 tax-free fund over a working career. And tax loss harvesting can claw back thousands every single year the market gets volatile. These are not theoretical. These are strategies written into the tax code right now. Keep watching, because the last two strategies build directly on what you already know, and together, all five form a complete retirement tax blueprint. In 2024, if you earn more than $161,000 as a single filer or $240,000 as a married couple, the IRS says you cannot contribute directly to a Roth IRA. Most people hear that and give up. But there is a completely legal workaround that has existed since 2010, the Backdoor Roth IRA. Here is how it works in 2 steps. Step 1, contribute up to $7,000, or $8,000 if you are over 50, to a traditional IRA. Do not deduct it. Just let it sit as an after-tax contribution. Step 2, convert the traditional IRA to a Roth IRA. Since you already paid taxes on the money, the conversion is tax-free. Boom. You are in the Roth. Every year. Regardless of income. High earners who do this consistently for 20 years could accumulate over $400,000 in a completely tax-free Roth account. One important warning. If you have existing pre-tax money in any traditional IRA, the pro-rata rule kicks in and complicates the tax math. A simple fix is to roll those pre-tax funds into your employer 401k first. Always consult a tax professional before executing this, but the strategy itself is rock solid. This is the one that makes people's jaws drop. In the United States, if your taxable income falls below $47,025 as a single filer or $94,050 as a married couple in 2024, your federal long-term capital gains tax rate is exactly 0%. 0. That means if you can engineer your income to stay below those thresholds in any given year, during early retirement, a career break, or a low-income year, you can sell appreciated investments and pay absolutely nothing in federal capital gains tax. Here is a real-world example. A couple retires at 55 with $1.2 million in a taxable brokerage account. They live on $70,000 per year. Their Social Security has not kicked in yet, so most of their income comes from investment sales. By carefully managing which assets they sell and staying under the $94,050 threshold, they pay 0 in capital gains tax year after year. Over a decade, that strategy could preserve $80,000 to $120,000 that would otherwise go to the IRS. When you combine this with the Roth conversion ladder and the HSA strategy, you are building what financial planners call a tax-diversified retirement, and it is completely legal. Here is what a complete tax optimization blueprint looks like in practice. In your working years, you max out your HSA every single year and invest it in low-cost index funds. You contribute to your 401k for the employer match, then pivot to maxing a backdoor Roth IRA if you are above the income threshold. Any additional investing goes into a taxable brokerage where you apply tax loss harvesting during volatile markets. Then, when you hit early retirement or a low-income transition period, you execute the Roth conversion ladder, converting chunks of your traditional IRA into Roth at low tax rates before required minimum distributions force you into a higher bracket. And throughout retirement, you carefully manage withdrawals to stay inside the 0% capital gains bracket whenever possible. This is not a complicated system. It is 5 strategies working together like gears in a machine. Each one is powerful on its own. Combined, they can save the average millennial $150,000 to $300,000 in lifetime taxes. That is money that stays in your pocket, compounding, growing, and funding the retirement you actually want. Let's bring it all home. Strategy 1, the Roth conversion ladder, convert pre-tax money in low-income years to slash your future tax bill. Strategy 2, the HSA Triple Tax Advantage, invest your HSA like a stealth IRA and let it compound tax-free for decades. Strategy 3, tax loss harvesting, turn market dips into real tax savings in your brokerage account. Strategy 4, the Backdoor Roth IRA, get into a Roth regardless of your income with a simple 2-step process. And Strategy 5, the 0% capital gains bracket, time your asset sales during low-income years and legally pay 0 in federal capital gains tax. None of these require a finance degree. None of them are shady. They are all sitting in the tax code right now, waiting for people smart enough to use them. If this video opened your eyes, hit subscribe. We drop weekly money tips that your financial advisor wishes you didn't know. And if you want to go even deeper, watch our video on how to build a $1 million Roth IRA on a normal salary. The link is on screen right now. Your future self will thank you.